Hey everybody, hope everyone is doing well. I may have accidentally scheduled the stream for 4:30 Central Time, 5:30 Eastern, but I meant to schedule it for 4:30 Eastern and 3:30 or 3:15, excuse me, 3:15 Central Time. So, anyways, we're going to go ahead and start now. So, first, let's talk about the weekly chart. And we can see on the weekly chart right here, we're getting high one buy. And this is always an interesting situation. I'm testing something out on the mic. Can anyone tell me if they hear an echo or if it sounds different than any of the other streams? Anyways, while I'm waiting for a few answers, we have a high one buy right here, and it's an inside bar. The bulls, they want a high one buy and a strong second leg up. More likely, we're going to get sellers somewhere above. So the bulls, they're hoping they can get this bar to close on its high, leading to a strong high one going into next week. And the bears, they want the opposite. The bears want to sell this bar off and create a weak doji. So we'll see. We have 1 day left. Open of the day, 38 even. Close, 39 even. So the bulls, they have the bar about 20 points above the open. So it would not be that hard to get the bar to close back at the open of the day. Okay, interesting. I have the door closed in this room, so I'm just kind of playing around with the sound. So that's why I was asking. Thank you all for commenting about the echo, whether or not. And daily chart, I think this is really interesting. So here on the daily chart, we had a low one short on Monday, and it triggered on Tuesday. And it's very common for the market to go below a bar, especially a bad low one for a bar or two, and then reverse up. And right here, we have a failed low one. Failed low ones often pull back and create second entries. The only problem with this second entry here is one easy thing to look at is the moving average, this blue line where my cursor is. That's a 20 period exponential moving average. And the moving average is flat. So that tells you you're mostly in a trading range. Anyways, the reason I'm bringing that up is here, if we triggered the buy, which obviously we did today, the bulls can call it a second entry here, and the bears can call it the setup for a low two. So the bears, they want a revert, they want a pullback, low one, another pullback, low two, and then a sell off down to here. Now, if I'm a bear, and let's say I exited shorts above the September 7th high right here, what am I looking for? I'm looking for a second entry short. So I would exit shorts above this bar, hypothetically. I wouldn't sell here because too much risk of a second leg. And then we get this big bull bar. To me, that's a problem for the bears. Let me go to a Globex chart. That paints it. It's easier to see. So look at this. Whoops, I did not mean to do that. So look at this Globex chart for just a minute. Now it's real easy. We have a sell-off, pullback, low one on the 12th, rally. So tomorrow, imagine this. What would the bar have to look like tomorrow to convince traders to sell? At a minimum, you want a bear bar closing on its low. But this bar alone is relatively big. It's about 50 points, 40 points, and that's a big bar. So the bears, at a minimum, they need to get a bear bar probably closing down here on its low. And you know that's probably not going to happen. So the bulls, you'll have bulls buying here. And what will they do? Some bulls will put a stop maybe slightly down here or maybe halfway, betting that if they're hoping the bulls get strong follow through. In other words, this is what the bulls want. They want to break out, measured move up. And then all of these traders, they'd want a measured move up above the all-time high. You know the market's in a trading range, and whenever I see a good bar and we're in a trading range, excuse me, I'm always expecting disappointment. And when I look at this bar, it's strong, it's good follow through, it's a good entry bar. And I look at it, it's trapping a lot of traders that sold the high of this bar. So it's kind of like this. Here, big bull bar, but look at the follow through, fairly disappointing. So you will have traders, just like here, they'll buy the close of this bar. Bulls, they'll buy the close of this bar. And their hope is it looks something like this, big bar, and then this bar opened and it rallied. So tomorrow will be interesting. How deep is the pullback going to be? Are we going to get a big pullback or a small pullback? So that's what traders will pay attention to. The deeper the pullback, the more disappointment. But overall, I still think we may try and form an inside week. So I don't think we're going to get up here before the end of the week. We might, but let's see, the close of this bar, 59.5. High of this bar, 97.5. So really all we have to do is go up for another 40 points and we'd get there. 4,600, big round number. I do think we'll get up here, but I do not think it's going to be in the next day. Remember, what you have to remember, and this is something you just learn more and more the longer you look at markets, this is setting up a high one on a weekly chart. Whenever you get a rally like this, deep pullback, and you're getting a lower high, some traders call that it's a minor pivot. Here's a pivot high, pullback. And since this high right here is below this high, that's a high one on a higher time frame. And we know that because we can look at a weekly chart and we see the high one. Someone said possible gamma unwind tomorrow. I guess that's options. I don't really pay too much attention to all the different pieces with options. I pay a little bit of attention to options, but not really all that much. So we've talked about the daily chart, and now let's go to the 5-minute. First bar of the day, we have a bear bar and a big gap up. Sometimes what I'll do whenever we get a big gap, I'll often go to the Globex chart. So I'll pull up a 5-minute chart of the Globex session. Here it is. And I'll take a look at the open compared to the Globex market. And this is bar one right here. Does that look like all that great of a setup to sell? No, you're in the middle of a tight trading range, lack of energy, and we're selling off, but we're just testing these lows. Anyways, bar one, bear bar, testing the open of the week, this green line. At the moment, I think we're probably going to pull back and try and test the breakout point right here. Some bears, it's an obvious bad sell signal on the daily chart. So you know this high is a magnet and we'll probably test it. Bulls, what will they do? The bulls will buy, betting that this blue line will be support, which is yesterday's high. In bar two, we have a bull bar. So we have an big bear bar on bar one with the tail. And then bar two, we have an inside bar with the bull body closing below its midpoint. That's a sign of weakness and increases the probability that the market's going to go more sideways. Bar one is strong enough, we'll probably get a second leg down. But traders who sold on the way down and sold the pullback, what do you think they're going to do? They might buy back shorts somewhere down here. And I'll do that pretty frequently. If you get a big bear bar and I sell and I scale in, I'm going to be disappointed by bar two. And I'm hoping for a second leg down on a smaller time frame. Leg one, pullback. Leg two, I'm hoping leg two crashes down here. I'm expecting leg two to be disappointing. And then we see bar three. Bar three, what happened? Well, when I look at bar three, I see that it broke below one, it broke below two, but it couldn't close below one and close below two. And if I'm a bear, I'm looking at that and saying, that's disappointing. Disappointment is the hallmark of a trading range, and the market's confusing. Is it clearly bullish? It's got a gap up, but why is it a 3 bar micro channel? And bar 3 is a bad high one. It's a bad stop entry buy above the bar. And because of that, the market's probably in a limit order market, which means we're in a trading range. And you know what I say on just about every blog post, 80 there's at least an 80% chance that you're going to get a trading range open. And what that means is there's going to be a 20% chance of a trend from the open. Is it really 80% and is it really 20%? I don't know. To me, it's a good enough probability where I just try and keep it simple. A lot of what I do with trading, I want to keep fairly simple. So I don't want to think too far. Is it exactly 80 or is it 83? Is it 77%? For me, who cares? Most of the time, you're going to form a double bottom or a double top and a wedge bottom and a wedge top. And what that also means is most of the time, you're going to go sideways for the first 6 to 12 bars. So if I'm trading hoping for a trend from the open, which I almost do that every day, I'm always hoping for a trend from the open. I'm optimistic about a trend from the open, but I'm expecting to be disappointed. Here, I'm hoping to get strong bull bars, but we don't get strong bull bars. I'm hoping to get strong bear bars, but I'm expecting disappointment. So if I'm selling and selling a pullback and then I see bar 3, I'm disappointed. I'm going to start buying back shorts. Bar 4, we have an inside bar. So bulls, they're making money. The bears, they're trending. It's real subtle, but it's better for the bears than the bulls. We're getting a low or a high, lower high, equal high, lower high. So the bears are preventing the bulls from triggering above bars, and that's good for the bull. That's good for the bears, but it's still not that strong, and that will lower the probability of traders. There we go. That will lower the probability of traders buying below the bar or selling below the bar. Excuse me, that'll lower the probability of traders buying above the bar or selling below the bar. Bar 4, bear bar, trying to break out and get a downside breakout. But look at this market. A lot of overlapping bars, obvious magnet below. Even if we go a little bit lower, there's probably buyers below bar 5 scaling in lower. And then look what happened on bar 6. Everybody in the world started seeing this as a wedge and the market started to reverse. And typically, this is often how small pullback trends can begin. This is not great context for a small pullback trend because of the higher time frame. But in small pullback bear trend, if I said bull trend, but what often happens is you get a tight sell off, and it happens pretty regularly on. Let's find a kind of like this. It's not really great because there's gaps there. If find what I'm looking for here. Here's kind of one. So we have this gap sideways trading, and then we get these bear bars. And you look at it and you think, yeah, it's a leg in a trading range, but it's a tight trading range. And then we get this bar. This bar is breaking out of a tight trading range. And then you get a follow through bar. And you can see the market is starting to pull back less and less. And obviously, traders at this point are giving up. This is what the bears are hoping for, but too much overlap on the open of today. So big outside up bar. What about buying the close of the bar? Some traders might, but it's a big bar with big risk. It's forcing you to buy high. Typically, a good rule of thumb is outside bars are generally low probability, and usually there's more sellers above the bar than buyers above the bar. So outside up, but probably sellers not far above. And then we went outside down. A lot of traders, I want to see on a 1 minute chart really quick. This is 9:55 to 10 a.m. And what I want to see is I want to see how long it took for the bar to reverse down. So you can see this is the close of that bar on the 5 minute chart. Where'd it go? Here it is. So that's the first bar. Let me move myself out of the way. That's the first bar right here. And then you can see this bear bar on the 1 minute chart. That is the first 1 minute of this outside down bar. So you look at that bar and you think, gee, that's really disappointing. And then big follow through bar. And everybody saw this and immediately started to sell. So why did they sell? Because when they looked at this bar right here, we started to rally. And instead, everybody immediately started to sell. If you're buying a breakout, you don't want everybody to immediately start selling. You want everyone to immediately panic and start buying. So big outside down bar, it's possible we still have to get down to the 52 high. And in fact, I think we do. And because of that, I think there might be more sellers down here than buyers. When you look at bar 7, 7 did one thing actually important. It trapped all the bulls who were buying up here. So let's look at a 2-minute chart just to keep it easier. Here's a 2-minute chart, big bull bar, and then a big sell off. That big sell off traps bulls. It was reasonable to buy this close and scale in lower. And that's what happened. And if you're a bull and you did that, you got trapped. You got punished for buying high in a trading range. So we may get 2 small legs down. Bar 9, low 1 short, but it's a big bar. Probably going to go at least a little bit lower. If I'm a bear and I sell below that bar, I'm going to be really quick to exit. So I want the market, and I think I did sell below that bar. I want the market to plunge down rather quickly. And if it starts to stall or kind of trickles down, I'm going to start buying back shorts and just betting on a trading range. I'm already expecting a trading range. And then you see this bar. That bar is fairly disappointing. A lot of traders, they started selling on the way up, getting out. But that's a bad stop entry buy above bar 8. And because of that, you'll probably more sellers above. And then look at 9. 9 sold off, broke below the 52 high, and then reversed up. When you look at 9, does that look like the start of a strong bear trend? Or does that look like the start of a trading range? Obviously, it looks like a trading range. When you're in a trading range and you start to get 2 or 3 legs down, 1, 2, 3, bar 1, bar 8, bar 9, 3 pushes down, traders start to be quick to buy back their shorts. And that's what's happening on 9. 10, test of the 9 low, trying to break below 9. Good bar for the bears, but if we reverse up on 10, that you could call that a micro double bottom or a failed breakout of a wedge. Wedge, 1, 6, 9. We broke below 9 on 10. So if we turn up on 11, that's a failed breakout of a wedge on a smaller time frame. So 11, big outside up bar. You had traders who bought above 6, and instead of selling below 6, what do? They put a stop, a measured move down. So they look at the market and they say, no way this is a bear trend. This is a trading range. And I'm going to buy up here, and I'm going to buy more below 6, even if we go down there. And if we go far below 6, if we go somewhere down here, I'm going to scale in. And you can see that is what happened with this bar right here. 11, bull bar, outside up, probably going to find sellers not far above where the bulls got trapped on 6, and a big bear bar on 7, but a possible wedge, 1, 6, and 11. And because of that, we may get a rally. It's possible we have to get back to the open of the day. And speaking of the open of the day, look what happened at the 7 high. The open of the day on bar 1, 42 even. And look at the high of bar 7, 42.25. Trading ranges, it's really common for the markets to test the open several times. And when you look at this bear leg in a trading range and you have a wedge bottom after a gap up, especially when the opening range is not that big, this is a great example of that kind of 40% chance I'd mentioned in the blog. 80% chance that you get a swing trade beginning before the end of the second hour. And typically, the swing trade begins after the formation of a double bottom or double top, or a wedge bottom or wedge top. Here we have a wedge bottom, 1, 6, and 11. bull bar. The range isn't very big. It's 45 to 26 or 28. So not really big, less than 20 points. It's reasonable to expect the range to double. So if you buy above 11, put a stop below 11, maybe there's a 40% chance that you get a measured move from the low of bar 11 to the open of the day, projecting up. Now, why the open of the day and not the high of the day? It's reasonable for both. But the low of the day to the open of the day, projecting all the way up here, does one thing really interesting. And what that does is it creates a measured move of the opening range. And it creates a measured move of the opening range, and it puts the open of the day in the middle of the day. So if whenever you get a doji, it's really common. Let's find a doji where the open is in the middle, kind of like right here. It's July 27th of 23. Now, just because I'm curious, I want to go back to it. And by the way, that's one thing that's important, when you're always take the time whenever you're looking at the charts and just studying and looking at things. It's important to learn to be curious with things regarding the market. So what I mean by that, look at bars and then look at smaller time frames of that bar. I have a new keyboard and I'm not quite used to it, so I'm having to sort of adjust here. That's really odd. Oh, that's the yes, I see. Anyways, the point I'm making is a bar like yesterday, actually that example works sort of well. In order to get a bar that has where the open is in the middle of the range, often you form a lower portion of the range and then you form the upper portion of the range, and the open becomes the midpoint. So reasonable swing buy on 11, follow through 12, probably buy the close, buyers below 12, 13, bull bar, closing on its high, probably a leg in a trading range, but you have to be open to the possibility of a measured move up. Bear bar, 14, some profit taking at the 6 close and the 7 open right here. Some bulls bought the close of 6, they buy more lower, and they look to get out right here. Trying to make the chart a little bit bigger so it's easier to see. And then 15, bull bar. We had a bad low 1, bad stop entry sell below 14. Traders bought it on 15. Always in long, probably buyers below. Micro channel since 11. Good for the bulls, probably going to go at least a little bit higher. And then 16, we have consecutive bull bars. What about selling the high of 1 right here, betting that this is going to be a trading range day? You can probably do that and you'll probably make money. But my only problem with that is whenever you have a strong rally like this and bears are not making money below bars, and it's really difficult to make money above bars, I really am not interested in selling. I'd rather wait for more selling pressure. Sure, you might miss a trade, but in general, I don't want to be the first to sell when you're in a tight bull channel. Bear bar on 17, disappointing for the bulls, profit taking, probably sellers above. And then 18, another doji, probably buyers below 18, scaling in lower, far from this, the moving average. So we may have to get closer to it, but it's still relatively difficult to make money. You sell the high of 16 at 46.25, the high of the next bar, 47.50. So it went up a point. And it allowed you to make basically 1 point. So you sell the high of this bar, 46.25. You scale in 1 point higher and you make a 1 point scalp. Sounds great. But the problem is the size of this bar, bar 16, is 3 points. Does it really make mathematical sense to be scalping for 1 point when the range of this one bar is 3 points tall? I wouldn't do that. To me, that's a problem. And then you can see what happened on 19. So this is the point I'm making. A lot of traders, they're not going to know, they're not going to scalp for 1 point if they look at this bar like bar 16 and agree that it's a 6 point tall bar. If the bar is 6 points, they're going to be a lot less interested in scalping for 1 point. And because of that, a lot of those traders are going to give me just 1 second. I want to fix something and I'll finish. There we go. Anyways, the point I'm making is this. The bulls, the bears that sold above 16, if you did not, if you tried to scalp for 2 points, you would have gotten trapped on 18. So in other words, if you sold and you did not get out by 18, look what happened on 19 and 20. So let's say you sold the 16 high, 46.25, and you scale in 2 points higher, 47, 48.25. You get filled at 11.05, which is bar 19. So then you move your you move your target to break even, and you try and get out at 46.25. Well, look at the low of this bar, 46.75. Look at the low of 21 and then 22. 22, it's not letting you out. 23 tries to let you out. 24 finally lets you out. But my only problem is, what did you risk for that trade? You made 2 points. Some traders, they'll sell 2 points higher, sell 2 points higher, but it can be rather dangerous. 17 and 18, there's small bars, possible final flag, so it's selling pressure. 19, bull breakout above 17 and 18, but probably going to pull back fairly soon. And then 20, we have a bull bar closing above the bars to the left. Let me get a sip of water. My throat has been somewhat dry, so that's why I keep taking a lot of sips of water. Anyways, this is forming somewhat of a parabolic wedge. 1, 2, 3. And because of that, it's becoming slightly unsustainable, which means we're probably going to get a deep pullback. Plus, it's going to be hard for the bulls to overcome the sell-off on the open. They can still get a bull trend, but bull trends typically, bull breakouts, which we have here, typically evolve into channels. And in order to evolve into a channel, we need a deep pullback. 21, doji, probably buyers below. But for me, if I'm a bull and I bought above 11 here and I'm trailing my stop, I'm getting out maybe 2 points, 3 points below any bar at this point. Therefore, I'm not willing to buy below 21. If anything, I'm selling out of longs below 21. 22, we broke below 21, pulled back. High one buy above 22, but probably sellers above, and it didn't trigger. 23, broke below 22 and another bear bar. So now we have two consecutive bear bars, none closing below their midpoints, and one doji, probably sellers above, and probably going to go more sideways. 24 bear breakout testing near the one low, probably going to go at least a little bit lower, may have to test the 15 close. And then here, 25, test near the 24 high. We tested the 23 low, turned down. And then 26, we have a bear bar closing on its low. Is this always in short? I don't know. I don't think it is. It might be strong enough for a small second leg, But this rally was fairly strong. Therefore, I think the best the bears can realistically do is make the market form a trading range. 27, bear breakout to the moving average, reversal up, weak doji, probably sellers above 27 and at least a small second leg down. Maybe we test the midpoint of this bar. But as far as selling above 27, I think the problem with selling above 27 is the market is right at the moving average. And that's an area, sorry about that. That's an area where traders will buy. So I think there's going to be less sellers selling above this bar and more traders buying. You had bears who were selling all the way up, they got trapped. They'll use any pullback to try and buy back their shorts at a smaller loss. 28, surprise bar for the bears. If I was short, 24, 25, which actually, I think I sold one of those bars. I ended up getting out basically break even as 27 turned up. 28, I think the remaining bears are getting out and bulls are buying. 28 is enough of a surprise. We may get a small second leg up. Tight bear channel, so increases the risk of a trading range above 28, but it's an okay buy above betting on a test of the 21 high. And then 29, a bull bar. So what do you notice about this pattern? Well, we have a strong rally, and then we have a trend line break. So that's the start of a major trend reversal. The bears, they want a retest of the 21 high, and they want a double top, lower high, or even a higher high. But most importantly, they want a higher high major trend reversal. Or most importantly, they want a major trend reversal. And the bulls are buying all the way up because they know they can scale in lower. They can buy here, they can buy here, they can buy at the moving average. And they know the odds are the market's going to form a trading range. And therefore, low probability that we're just going to melt down. 27 and then 28, consecutive bull bars. If you're a bear, if you're a bull and you bought the close at 21 or 20, you're disappointed by the 4 or 5 consecutive bear bars. But then when you see 28, you start to think, gee, I don't know. If I bought here and started scaling in, maybe I shouldn't get out break even on my entire trade. Maybe I can get out at the high close at my first entry. So I'll break even on my first entry and I'll make a profit on my scale ins. And then you look and you see 28, you start to see 29 race up. You see the lack of overlap from 28 and 29. And you start to think, you know, hey, maybe I should take half of my trade off and swing the balance. Maybe we'll get a breakout. 20, and then you get 30 bull bar, but it's a weak stop entry short, and then you get an outside down on 31. What about selling below 31? You will have traders sell below 31, betting on a major trend reversal, double top. You can call it a lower high major trend reversal if you want. The only problem with this major trend reversal is that this is strong enough. It's a strong enough rally that it's a strong enough rally and fairly weak sell off. We couldn't even get below the moving average. And then the rally up to bar 30 is really too tight. And that increases the odds that we're going to go sideways. So whenever you get a strong micro channel for the retest in a major trend reversal up or down, it lowers the probability for the bears. So therefore, there's probably buyers below 31, and we're going to go sideways to up. 32, bear bar. You can see some bulls that bought the 30 close, disappointed 31, getting out break even. 33, bull bar, outside up. Good for the bulls. A little bit of a surprise, probably going at least a little bit higher. You can see we're breaking above the bars to the left. So it's a bull breakout of a trading range. All trading ranges are it's a bull breakout of a double top. All double tops are trading ranges. And therefore, when you get a bull breakout above a double top, that means you may get a measure move up of this trading range. And that projects up here. 34, surprise bar, but a deep pullback, second leg up from the 27 low to the 31 high, pullback, second leg. What about buying the close of 34? I would not. For me, I think it's more of a profit-taking bar. And then we have a bear bar on 35. 35, even though it's not a great sell below, especially with the following two consecutive bear bars, two consecutive bull bars, 33, 34. It's not a terrible sell below 35. it's got a tail below 35. So some traders will sell below the bar. But if they do, they're going to be fairly quick to get out. And there's a few ways they can manage that. They can sell below the bar, and if this bar closes as a doji, some get out. Others, they'll sell more above the bar, betting on a bad high one. And that's what happened on 37. So 36, it's a weak entry bar for the bears below 35, but it created a bad high one for the bulls. Therefore, probably sellers above, and they'll scale in. And 37 is not a good entry bar. And then we got a weak bear bar on 38. So what happened on 38? You had bears selling below 35, scaling in higher, trying to get out break even at the 35 low during 38. $39 bull bar. The bears, because you're in a bull trend, a lot of bears will get out above 39. It's a second entry buy in a bull trend, and that makes it a more dangerous bar to sell above. And the bar's closing on its high. You will have bears look at this as a second entry buy, but a possible final flag, which means we may rally up to here and then pull back to the apex or the midpoint of this final flag. The other thing to consider, one push, 21, second push, 34. It's possible we get a third push up and then a reversal. Consecutive bull bars, 39, 40, good for the bulls, probably going at least a little bit higher. 41, another bull bar, good for the bulls, but a possible wedge, and it's nested. So we have a wedge, 21, 34, and 41. And then we also have a nested wedge, 31, 34, and then 41 right here. 42, doji, so starting to go sideways probably near resistance. Possible measure move up here. Therefore, we could easily rally up to the 61, 62 area. 63, bear bar, probably buyers below. 64, consecutive bear bars. Disappointing for the bulls who bought above 39. It's a reminder that those bulls were scalping. However, the rally up from the 39 high to the 42 high is strong enough that the bears who sold the 39 high and scaled in higher, they will probably look to exit around the high of 39. And that means the high of 39 may act as support. $45, pull back from the bear breakout below 43. Therefore, probably buyers below 45. You can call it a low one short. And then 46, you can see it triggered below 45, reversed up. 46 is also a bad stop entry buy above the bar. So there might be more sellers above. For the bulls, we rallied on 45 and then we pulled back on 46. So if we rally on 46, which we did for half the bar, that is a second leg up from 45. You can see it on a 1 minute chart. So the open of this bar is 13.20. So if we look at a 1 minute chart right here, it's probably going to be, it's this right here. So you can see tight bear channel. We sold off. We had this bull breakout, pullback, and then a second leg. But a lot of traders saw this as a second leg. You can call it an expanding triangle. 1, 2, 3, 1, 2, 3. By the way, it's really important to spend time when you see a pattern like this right here. Look at smaller time frames and try to understand it's a parabolic wedge. So larger patterns are made up of a lot of smaller patterns, as you know, and it's important to understand that. So outside down 47, but probably buyers below, limited downside. 48, you have a wedge with 44, 46, 48. Reasonable for the bears to exit above the bar, but the upside's probably limited. Good bar for the bulls, 49. What about buying the close of the bar? I would not. This might just be a buy vacuum test of resistance like the 41 close. And then you see 50. For me, if I'm a bull and I'm buying pretty late in a rally at the top of the trading range, I'm hoping that the next bar just races up to these targets. And if it doesn't and we get a doji, I'm going to be really quick to get out of the trade. Now, why would I be quick to get out of the trade? Because of this. Here, we had you look at the high of 49. 49 is a bull bar. I know it's kind of a poorly drawn line. So think of it as a line. And then look at 50. 50 is opened right here and it sold off to here. And then it rallied back to here. So what do you call that on like a 1 minute chart, 30-second chart? You call it a major trend reversal. Here's a high. Here's another high. So we're creating a double top. And it doesn't look that way. But if you really look at the bar and study it, you'll see that's exactly what happened. So this bar, 50, has a lot of meaning behind the bar. It broke a trend line from 49, the bull trend. Remember, every breakout is a bull trend on a small enough time frame. So this doji is a trend line break of a breakout on a small enough time frame. 51, another bear bar, but you can see disappointed bulls. They're exiting up here. And then 52 looks like the bulls are giving up. Weak signal bar for the bears who sold below 50. Decent entry bar on 52. If 53 is a bull bar closing on its high, the bears, they're hoping for a breakout of a double bottom. And they're probably going to get it. At least they'll probably break 1 or 2 ticks below 48, which we did right here. And then 53, the bears are hoping we get a plunge, and instead we got a bull bar. So now everybody's going to question, is 53 a pullback from the sell off down to the 53 low? So is this a sell off down to 53, pull back to the midpoint of the bar, second leg down? Or is it a two-legged pullback and a second leg bear trap? Leg one, pullback, leg two. And you can see what happened on 53. We broke below 53 and we never triggered the buy above 53. 54, bear bar closing on its low. 55, doji. And then 56, another doji. The bears, they're trying to trend lower. However, this does not look like something that's going to lead to a strong bear breakout to the downside. This looks like more of a trading range. And if it's a trading range, we might find support at the start at these lows right here. 57, inside bar, probably buyers below, but the channel is getting tight. And whenever you get a tight bear channel and you start to hold below the moving average, you got to at least respect the fact or the thought of a possible small pullback bear sell-off and maybe a test of the bar one high right here. Another doji, so bulls, they bought the close, scalped out, more disappointment for the bears. And then 60, another bull bar. So does this look like we're racing to the downside? No, it looks like a trading range, and we're probably going to start to go sideways soon. 61, outside up, bull bar closing on its high. We've tried to test down several times. For the bears, I would get out. Always in bears, they certainly get out above 61. Bulls will consider buying above the bar, 20 gap bar buy. We may test the highs of the day, and it's possible we rally up to the measured move target, the low of bar 10 and the high of bar 1 up to here. By the way, I wanted to see something. You can see we went several ticks above the low of the day to the open, which was right here. So you have to wonder if we're going to test the high of bar 1, which is up here. Okay, followed through 62. Is it buy the close? I think the bulls need one more bar, but bulls will probably buy the first pullback. 63, another bull bar. It's possible we had a breakout and then a pause on 62 and another breakout bar on 63. So it's a little bit parabolic. It's not symmetrical, and that lowers the probability of buying the close of 63. But it's still 3 consecutive bull bars and probably better to be long than flat. 64, what happened? Well, again, think about what happened on 50. 64 is breaking a bull a bull breakout. 64 is breaking a trend line and testing the highs. So it's a sign that it's getting a little bit weaker. It's still a low probability sell below the bars. Therefore, it's kind of like the same concept as over here. We had this bull trend line break below the moving average, and we're getting a retest of the highs. But the retest is just too strong, and that will increase the probability of sideways rather than a lot lower. Bear bar on 65, and bulls tried to buy below 64. Probably a second leg up from the low of 61 to the high of 63, testing up here. 66, inside bar, high one buy. There might be more sellers above, but this was a surprise on 61 to 63 or 64, and surprises generally get second legs. 67, bull bar, closing on its high. Possible vacuum test of support. Measured move from the low of 27, high of 21, and the low of the day to the high of bar 1 up to here. And you can see we tested it on this bear bar right here. 68, bear bar. It's a second leg up after the rally up to 64. I think it's okay to get out below any bar, certainly a bear bar closing on its low. And 69, weak entry bar, high one buy above the bar. It's possible we have to get 3 legs up, 1, 2, and then 3. But overall, I think it's certainly okay to take profits here. If you bought above 61, you have a pretty decent profit, and you're just so late in the day. And then 670, bear bar, 3 consecutive bear bars. We'll probably test the breakout point 66, which we did. And then 71, now we have 4 consecutive bear bars, 2 of them closing on their lows. Might be always in short, and I would certainly be out of longs at this point. Too much risk that we test all the way down to the 61 low. Therefore, 71 might be sell to close. 72, strong bear bar, still probably sell to close, but look where you are. You're at the 61 high, and that's exactly where limit order bears who sold the high and started scaling in got trapped. That will automatically lower the probability of selling here. And when you look at this, as strong as this is, you don't know if this is this bears aggressively selling all the way down, or is this more due to bulls stepping aside? If everybody thinks we're going to test support, the 61 high or the 61 low, you will have traders waiting to buy. Instead of buying up here, they move their orders to buy down here. And then you have 73. 73 is a doji. We sold off below the 61 high, tested near the midpoint of the bar, and reversed up. It's a micro channel, 1, 2, 3, 4, 5, 6 bars. Probably the first reversal up will fail, but look what you have. And this is a classic sign of trading range price action. We have a micro channel from the 61 low to the 68 high, and then a micro channel from the 68 high to the 73 low. Do you think that happens a lot in trends? No, that happens in trading ranges, and this makes me think we're in a trading range. Probably sellers above 73. And by bar 74, I think a lot of traders would just get out anywhere. And you can see that's what happened on this outside down bar. The bears, the bulls, they had a 2-legged pullback or 3-legged pullback up to 77. We rallied on 74, down on 74, up on 75, down on 75, up on 76, down on 76. And then 78, outside up. Probably just going to go sideways into the close. And we tried to test the breakout points up here. For always in, I don't think it was ever clearly always in short. And, problem with always in trading in tight trading range is these are such big bars that they're really lower. It lowers probability of doing anything. So I think it's better to avoid this kind of area. And, if you bought above 8, if you bought above 6, unfortunately you get out below 7, or as 6 starts to go down. If you sold below 7, you've got to get out somewhere in here. Always in short, 9, 10, somewhere in here. I don't know. I don't think so. I think we're testing the gap, but we have a big gap up. And this might be a 50% pullback. And I'd rather see a bar breaking below the moving average. And then always in bears, if they are short, they get out above this bar right here. Bulls buy above 11. 12, always in long, no reason to get out. And then at some point, I think traders just start to get out. Do they get out below these bars? I think they can. It's fairly climactic. And when you get a micro channel, the way I handle it is I generally put a stop if I'm still in the trade. I'll look at a bar, and if the bar's 2 points, 1 point, I'll typically put a stop maybe 2 points below any bar. And then I just get stopped out probably on this bar. And then I would just wait for the next trade. And the reason I do that is I want to protect what I've made. So if I'm buying above here, I'm going to be fairly quick to tighten my stop. And then are we always in short? We might be, but we're not below the moving average. And that increases the odds of a leg in a trading range. The bears that are short, they get out. If they don't get out above 27, I think they get out maybe a point or two above 27. And certainly above the 28 high. And always in long, bulls, they buy above 28. No reason to get out. I think it's okay to get out below 35. And if you do, you buy again above 39. And then 43, 44. What do you do in there? I don't know. For me, this is a lot of selling pressure in a wedge. I'd get out below a bear bar closing on its midpoint and wait. So I'd get out below 43 and then certainly below this bar. And then here, just a mess. Really too difficult to trade always in. It's a tight trading range. Better to trade with limit orders. Always in bears, if they are short below 52, I think, 53 would have closed on its high. I think they get out. Here, I don't think they have to. Maybe they put a stop 2 points above the bar and it didn't trigger on 54. And then at some point, you start to get these overlapping bars. Traders are just going to get out 1 or 2 points above a bar or above any bar. And then certainly above 61. 61, always in long, bulls buy, and they just get out below any bear bar. So if they don't get out below these dojis, they certainly get out below the third bear bar. Bears can start selling, but if they're selling down here, I think they'd be pretty quick to get out. So if I sold, whether or not I scaled in, I'm going to be trying to get out break even relatively quickly, and I'd let the rest go. For limit orders, lots of limit order traders, buyers below 1, buyers below 4, sellers above any of these bars, buyers below 6, maybe sellers above here, but it's leg 3. So I think in general, whenever you have 3 legs down or 3 legs up, it's usually a bad idea to bet more in the direction of the third leg. So 3 legs down, it's usually a bad idea to sell the third leg. Had I sold the third leg, had I sold above 8, and then I see a bar like 10, or a bar like 11, I am exiting the trade because 11 is a reasonable stop entry buy, and I'd rather look to buy than sell at that point. Probably buyers below, a little bit problematic here. You could say buyers below 21, first reversal down, but this is another problem with when in situations like this, it makes it unsustainable. The bulls never had a chance to buy a pullback, and that will lower the probability of traders buying below any bars. A lot of traders, if this is bar 11, that's 21. A lot of traders don't want to buy the 10th bar in a micro channel. They don't want to buy that pullback because there's an added risk of a reversal. What about sellers above these bars? Well, it's a 1, 2, 3, 4, 5, 6, 7. It's a 7-bar bear micro channel. But do you really want to sell the pullback at the moving average? No. And it's fairly deep pullback. Odds are trading range. So this is not a good area to sell. Probably buyers below any of these bars, and none of them triggered here. It's actually a ledge. And probably sellers above 36, buyers below 37. I thought sellers above 44 and buyers somewhere down here. And then you can trade some limit orders in here, but rather dangerous late in the day. Buy the close, sell the close. Probably sell the close 12, 13, 14, even 15 or 16. But I think it's pretty tough to do. You're getting near the high of the range and the upside's limited. You can see what happened. Look at what happened at 16. You buy the close of 16, it goes your way. And with all these overlapping bars, it went all the way back to the 16 close. So a lot of traders, they don't buy 16. They see this, but they know the odds are we're going to test back to the 16 close. And if we're going to test back to the 16 close because it was a bad bar, it wasn't really the greatest place to buy. And because of that, you'll have more sellers than what it appears selling and scaling in. And therefore, there's an increased probability that the market's going to allow those trapped bears out. And if the market's going to allow those trapped bears out, that means that we're probably going to retest this price level at some point soon. So if you don't buy here, you've got a reasonable probability of buying this exact same price or better fairly soon. So a lot of traders, they see this trading range and they think to themselves, we could easily have a 50% pullback from the low of 11, the high of 16. We could easily pull back to this green line, open of the week, which is also 50% from here to here. So the bulls are betting on one of two things. If I'm a bull, maybe I'm betting on this. I'm going to try and buy a limit order, a pullback here, because I know the odds are we're either going to pull back to 50%, or if we go straight up, we'll still get a pullback, and then I can buy right around the same entry price. And that's what happened right here. Traders started buying at that entry price. And I don't think it was sell the close here, probably buy the close on 29. Maybe buy the close 33, but not that clear. And then I wouldn't buy these. I think that's pretty challenging. And then probably buy the close 62, maybe 63 for a small second leg. And then probably sell the close 71, 72. But you got to be really quick to make decisions. You're selling low in a trading range. Let me take a look at a couple of questions. Someone says, I'm trading the Dow Jones and gold at all the time, but the candles are too big on a 5-minute time frame, and my risk is becoming too big. Should I go to a 1-minute chart and stay in that, or change between a 5 and a 1-minute chart? This is a classic question that gets asked occasionally. And what they're saying is, should I trade a 1-minute chart because I can't handle the risk on the 5-minute chart? And that is a very, very bad idea. And in general, it looks easy when you print out this chart. And by print it out, it looks easy at the end of the day. You look at a 1-minute chart and you think to yourself, yeah, bear channel, we had buying pressure. This is a lower low, pullback, third leg down. We have a wedge, 1, 2, 3, decent bull bar. I'm going to buy above here and hold, no reason to get out second leg. Sure, looks easy. But these bars are all, for one, they're 60 seconds. And the other problem is these bars don't form in the first. You don't have 60 seconds to make a decision, because what that would imply is you already know what you're going to do on the open of this bar. So by the close of this bar for a full 60 seconds in order to make a decision, you'd have had to already been able to make up your mind here. And the reality is this bar that we're looking at did not form on the first second of the open of the bar. It probably formed in the latter 30 seconds of the bar. That's why even on a 5-minute chart, you see it all the time. The bar does not form in the first 20% of the bar. It's really common for bars to even change directions halfway into the bar. Therefore, when you see this chart, you really have about 30 seconds to make up your mind. When you're looking at a 5-minute chart, sure, it may look like you have 5 minutes to make up your mind, but you almost never get 5 minutes to make up your mind. I mean, let's just look at this chart. Let's look at today's chart. What bar actually gave you 5 minutes to make up your mind? Do you think bar 11 closed, opened, and then in 30 seconds rallied up to here and then stayed at this price level for 4.5 minutes? Of course not. It tried to break to the downside. If I remember correctly, it spent half the time down here. So the point is, when this bar started to go up, you probably had 30 seconds to really decide what you were going to do, and maybe even less than that. But the more important piece is this: whenever you're trading a smaller time frame, you are reducing your risk, but you're also reducing your probability. If I go to a monthly chart, for example, right here, strong bull bar, okay? We have a month, we have months and years to figure out what to do here. Rally, trend line break, highs. I wouldn't be shocked at all if we get a second leg and test the higher high. So if somebody buys here and scales in lower, they're probably going to make money. If someone buys here, they're probably still going to make money. But you have months and months and months to think about this chart. But you're not going to make as much as you would on a 5-minute chart. So whenever you're trading a 1-minute chart, I think an easy answer to this question is whenever you're deciding, you should first off, you should never decide on a time frame because of risk, especially something smaller than a 5-minute chart. It's one thing to not trade a daily chart of the E-mini because the risk would be 50 points, 100 points. That's understandable. But to say, I'm not going to trade the 5-minute chart, I'm going to trade a 1-minute chart, I don't think that's a good idea. If you cannot make money on a 5-minute chart, you are never going to make money on a 1-minute chart. That's just a good rule of thumb. And what I would do is you have to respect risk. And if you cannot tolerate the risk, you got to trade a different market. So for me, there's plenty of markets I look at, and I might say, you know what, that risk is just too big for me. I'm not going to trade it. I'm going to study the market. I'm going to watch the market. But you know what? I'm going to hold that market aside. And that's okay. I think it's more than okay to look at all sorts of markets, study various charts and patterns, but you have to find a way to respect the risk. And what you're doing is you're in essence saying, "Hey, I'm going to trade a 5-minute chart, but I'm going to use a 1-minute chart to get in on my entry." And that looks easy to do in hindsight, but it's really not. So let's take a look at 11:20 to 11:25. You look right here and you get this great looking stop entry. Let me make sure that's even the right bar. I'm sorry, it is. It's 10:20 to 10:25. So right here, you look at this bar, and let me move the question out of the way. You look at this bar and you think, what a great stop entry on a 1-minute chart. It is, but it's really easy to screw that up because here's a great stop entry right here. Why not buy that? Well, if you bought that, are you fast enough to get out here? A lot of traders, if they're that are buying these bars, they buy here, they get disappointed by the follow through, they exit. They buy here, disappointed by the follow through, they exit. Buy here, disappointed, they exit. They're nibbling at the market and they're hoping they're going to take every one of these and be in and be out. And then they're hoping to see this and then this. And finally, they're catching a strong move. But I would focus on just the 5-minute chart. What are your thoughts on buying above 15? We're clearly always in long, but I was worried about a second leg trap since it's top of a trading range. Yeah, I talked about that some a little bit ago, but it's a possible double top. I thought the rally was strong enough that we would get a second leg up. In general, for me, one of my default ways to trade breakouts is if I'm buying something like 15, I'm going to keep it simple. I'm not putting a stop down here because the reality is I don't want to be long if we sell off down here. So for me, I'm going to put a stop probably below 15 because on the very next bar, if the next bar opens and goes straight down to the 15 low, the reality is there's too much momentum. We're probably going to get a second leg. I'd rather get stopped out of the trade and then reassess. So if traders buy, stop down here, and it never goes to it. And then they eventually end up getting out somewhere over here. Or they can hold if they're really determined. But for me, I'd rather get out and then re-enter. Is it okay to sell below 35 here, betting on a wedge and a gap to the close? Yeah, I think I actually did sell below 35 and I scaled in somewhere above 36 and actually mismanaged. I think I got out break even on the entire trade. I tried to get out down here and I was too slow for a small profit, but that was one trade I mismanaged. But you can see that's what traders did. They sold and they started getting out break even because they were disappointed with 36 and 37. Is it reasonable to buy the close of bar 6 and scale in here, since the market's in a trading range, that means there's a high probability of reversing up. Yes, there is a high probability of buying above 6, stop below, and scale. Buying above 6, buying more below 6, and getting out at your first entry. But I think a lot of traders, for me personally, I used to trade that way a lot, but for me, I've just found through time that if I buy above 6 and then I see a bar like 7 with a lot of momentum, I'm usually better just getting out of the trade and then looking to buy again, like above a bull bar, bar 11. You give up, you end up not getting the most optimum entry. But there's two benefits to trading that way. One is, and the most important, you're protecting your risk. The other problem is, I think, position size, volume, and position sizing. A lot of traders, if you're buying above this bar, it's not a great buy in the first place. But if you buy above it in your stops, let's say it's all the way down here, you're buying 40 to 22. So you're risking 18 points. And you're scaling in here. So let's say that's 18 points plus 8. What is that? 36, 26 points, something like that. So you're risking 26 points on the entire trade. But what do you stand to gain? If you buy this close and then you buy more here, you might be tempted to get out break even. But even if you get out at the high close, let's say, you make, what is that? 9 points. So you make pretty much a little more than 1/3 of your risk. And to me, I don't think it's that great of a trade. I think a lot of traders, for me, I think a lot of traders will trade really small, like buy above 6, wide stop, and they'll start increasing their position as the market goes up. Most traders should just focus on stop orders, though. Important question. Okay, question. Do you think instead, okay, the question's a little confusing. So let me see. Do you think, okay, so question, do you think instead of going in and out of trades, like trading always in, like what I talk about, buying above, exiting, buying above, exiting, selling, is it better to take one or two position, higher probability, scalp or swing? Well, it varies. A lot of traders, the more you trade, the more you start to see all these minor directions and these minor patterns, like what I was talking about on the 1-minute chart. You start to see right here, 45 and 47. That's a two-legged pullback on a 1-minute chart. And the more you start to recognize all these minor changes in direction, you start to see all these little trades, these 2-point trades, 3-point trades, and you start to be able to take them more and more. You look at this and you start to see this as a wedge, 1, 2, and then you're able to anticipate a possible reversal up. And that's the natural course of directions for traders. Traditionally, a swing trader might buy as it's going up, and then they put their stop all the way down here, and then it pulls back, new high. They put their stop here, pulls back, new high. They put their stop here, and they just hold until they get stopped out below right here. But the reality is that's not the most optimum thing to do, because if you bought, let's say, the close of 38.75, and you got stopped out below this bar, 50.75, you made 12 points. That's great and all, but this range is pretty good. How often does that happen? So that is why a lot of traders start to be quicker to take profits. And they followed up with saying, I think we'll make a lot less mistakes, like bar 27 here and bar 11 here. Well, these are not great sells. If you're selling below 11, that's a bad location to sell. You're buying basically the bottom of what's likely to be a trading range at support. 27 is not a great sell above the bar either. Typically, sellers above and a second leg down, but it's a bad location and it's at the moving average. Question, I didn't get caught. Oh, it's not really a question. Question: is bar 15 a climactic bar closing at resistance here? Well, it is a biclimax, and biclimaxes typically lead to sideways trading. And then we got follow through on 16, so bears started giving up, and we got a small second leg. But climaxes within breakouts typically lead to sideways trading for 1 to 3 bars, not a reversal. Read through questions. Okay, question: which markets are the most profitable or happen more often in the long run? Limit order or buy the close markets? Well, it depends on what your trading style is. Some traders, I think everybody, I think the longer traders trade, they become a little bit more aggressive with buy and sell to close. So here, when the market's rallying, they start to buy, and they start, increasing their position as the market's going up. And the risk might be bigger, a little bit bigger than usual, but they're going to be quick to get out. And limit order trading, they typically trade pretty small. So the way I look at limit order trading is kind of like it's a lot of work, but you can make a lot of fast trades. Buy this low, scale in, scalp out, sell above, scale in, scalp out, buy here, scale in, scalp out. And you can do it repeatedly back and forth. Both are profitable though. So I wouldn't necessarily say one is better than the other. Okay, so where do we go tomorrow? Like I said, I think it's going to be really interesting to see how deep of a pullback do we get on this bar. And then can the bulls get follow through? Can the bulls get another strong bull bar on the daily chart? Or will we get a doji and disappointment? If I had to guess, look where we are. We're right where traders got trapped. Bulls, probably buyers below September the 1st, scaling in, and they got trapped. And we're right there. So to me, I'm expecting disappointment tomorrow. I do not think we'll get another strong bull bar, but who knows? We'll see. All right. Thanks everybody for watching, and I will talk to everybody soon.